A home equity line of credit and a cash out refinance are both ways that homeowners can tap into their equity. But there are some key distinctions between the two. We're gonna first look at a home equity line of credit and the structure behind it. It is typically a revolving line of credit similar to a credit card. You have a balance, let's say of $100,000, that is unused and open available to you. If you don't withdraw any of those funds, you do not pay any interest. You can then take out up to the $100,000, and let's say you pull out $50,000, you're only gonna be charged interest on the $50,000 that you pull out. Interest rates on a home equity line of credit are typically variable, meaning that they can go up or down depending on what's going on in the market. They're typically tied to a benchmark rate, typically the Wall Street Journal prime rate. You'll hear home equity lines of credits quoted prime +1, prime +2, which means that you're getting the prime rate plus an additional percentage point or +2 additional percentage points. There are two phases during a home equity line of credit, the draw period and the repayment period. Typically, you have a 10-year draw period for a home equity line of credit, meaning you could take out funds at any point during those 10 years. Then you have a repayment period for the next 20 years, where you have to repay the money that you took out. During the first 10 years, you could withdraw money and pay it back. But during the next 20 years, you cannot draw any money out of the home equity line of credit. It typically converts from an interest-only loan for the first 10 years to principal and interest for the next 20 years. For fees and costs, a home equity line of credit typically has lower fees than a cash out refinance. Some lenders do charge annual fees with a home equity line of credit, so it's important to consider that depending on what option you go with. One major benefit is the flexibility with a home equity line of credit. What I mean by that is you don't have to take money out if you don't need it at that point in time. It might be more expensive, and interest rates are typically higher than a cash out refinance. But if you have $100,000 available to you, you don't need to use it right away. Only when you have a home renovation to do, you want to buy an investment property, or you have debt that you need to consolidate. Now we're going to look at a cash out refinance, which is where you get a new mortgage loan larger than your current one. The new mortgage loan will pay off your existing loan, and then you'll have proceeds left over that you can use for whatever you'd like. That difference between your new mortgage and your old one is going to be given to you, the borrower, as cash at closing. Typically, interest rates on a cash out refinance are going to be fixed, unlike a home equity line of credit, which are variable. Interest rates are typically lower on a cash out refinance because it's a first mortgage, whereas a HELOC or a home equity line of credit is in a second lien position. Borrowers will make monthly payments for principal and interest on a cash out refinance, and loan terms can be 15-year fixed, 20-year fixed, or 30-year fixed rate conventional loans. And terms can be 15, 20, or 30 years. Cash out refinances can happen with a variety of loans. You could do it for conventional loans, FHA, VA loans for veterans, non-QM loans such as DSCR loans, which are no income verification loans for investors. There's a multitude of options. Home equity lines of credit and cash out refinances both have their pros and cons. You definitely want to speak with a lender to find out which one is the best for you, and part of it is whether you need the money right now or down the road in the future. If you have any questions, please do not hesitate to reach out.